If you're listening to this right now, the markets in New York are technically closed. The lights are off on Wall Street. The traders are at home. But on the other side of the world, in Singapore, in Shanghai, and in the dark pools of the electronic futures market, absolute chaos is breaking out. We are witnessing something tonight that we haven't seen in the silver market for 45 years. We are seeing a true unadulterated supply shock. Not a speculative bubble, not a paper squeeze. A physical blockade of one of the most critical strategic assets on the planet. For the last 3 months, we have been warning you about a date, a single date that has been hanging over this market like a guillotine. January 1st, 2026. Most analysts told you it was a nothing burger. They said it was just an administrative change. They said China updates its export policies every year and that it wouldn't affect the flow of silver to the West. They told you that the global supply chain was resilient, that the COMEX had plenty of metal, and that the premiums we were seeing were just temporary noise. Well, tonight, those analysts are scrambling to rewrite their reports because approximately 4 hours ago, a document leaked from the Ministry of Commerce in Beijing. It hasn't hit the main pages of Bloomberg or Reuters yet. They are still trying to verify the translation. They are still trying to get a quote from a government official who isn't picking up the phone, but we have the document. And the contents of this leak are not just an administrative update. They are an economic declaration of war. The document details the implementation of the new strategic resource control measures that go into effect in exactly 11 days. And the headline is terrifying for anyone who is short silver. Starting January 1st, China is not just taxing silver exports. They are not just regulating them. They are implementing a full-scale licensing regime that effectively freezes the movement of silver out of the country. According to the text, any silver leaving the People's Republic of China, whether it is in the form of 1,000-ounce bars, grain, or even semi-processed paste, must now be accompanied by a strategic necessity waiver signed by the state planner. Do you know how many of those waivers have been granted for Q1 2026? 0, not 1. This means that starting on New Year's Day, roughly 15% of the global refining capacity for silver is being locked behind a wall. It is being trapped inside the Chinese domestic market. Why does this matter? Why should you care if metal is stuck in Shanghai? Because the West is broke, physically broke. The vaults in London are empty. The eligible inventory in New York has been drained to historic lows. The entire Western financial system has been surviving on a lifeline of leased metal flowing from the east to the west. We have been borrowing from Peter to pay Paul. And Peter just decided he isn't lending anymore. He is closing the bank. Tonight, I'm going to walk you through exactly what is happening in the Asian markets right now. I am going to explain why this export ban is the final nail in the coffin for the bullion banks who are trapped in a massive short position. And I am going to show you why the price you see on your screen, this $67 or $60 price, is an illusion that is about to be shattered. This is the story of the January 1st lockdown, and it starts with the panic we are seeing on the charts this very second. To understand the gravity of tonight, you have to understand the mechanism of the silver market. For the last 5 years, it has been a game of musical chairs played on a global scale. Since 2020, the industrial demand for silver has skyrocketed. We all know the reasons. Solar panels, electric vehicles, 5G infrastructure, AI data centers. We have covered the math extensively. The world consumes more silver than it mines. That is a fact. It is indisputable. For 5 years, we have run a deficit. Every year, the miners pull about 800 million ounces out of the ground. And every year, the world uses 1 billion ounces or more. So where did the extra metal come from? How did the price stay at $25, then $30, then $40 for so long? Why didn't it explode years ago? The answer is the great west to east flow. Historically, the West held the inventory. London and New York were the vaults of the world. Billions of ounces of legacy silver sat in JP Morgan's vaults in the LBMA warehouses, left over from the days when silver was money. As the deficits mounted, we drained those vaults. We melted down the legacy bars. We shipped them to China to be turned into solar paste. We shipped them to India to be turned into jewelry. But about 6 months ago, something changed. The flow reversed. The West ran out of loose metal, the easy silver was gone, the registered inventories on the COMEX dropped to levels that were dangerously low. Suddenly, the bullion banks in the West, the ones who had sold billions of paper ounces to investors, found themselves in a trap. They needed physical metal to deliver against their contracts, but they didn't have it. So they did what desperate addicts do. They went to the dealer. They went to China. In October of this year, we received credible intelligence that major U.S. bullion banks, specifically JP Morgan, entered into massive leasing agreements with Chinese state banks like the ICBC. The rumor was that they leased 4,000 metric tons of silver. That is nearly 130 million ounces. They borrowed this metal from China, shipped it to London and New York, and used it to calm the market. They used it to pretend that everything was fine. They used it to keep the price from going to $100 before the end of the year. But a lease is a loan, and loans have terms. And the most important term of that lease was the repayment date. The metal has to be returned. And here's where the January 1st lockdown turns a difficult situation into a fatal one. If China bans the export of silver on January 1st, that door slams shut. But it works both ways. It signals that China is hoarding. It signals that China views silver as a strategic asset that is too valuable to let leave the country. If JP Morgan and the other banks haven't already returned that 130 million ounces, they are in big trouble. But if they have returned it, it means the vaults in the West are empty again, and now they can't borrow anymore. The leak tonight confirms that China sees what is coming. They know the shortage is real. They know that the US dollar is weakening. They know that in a world of geopolitical tension, he who holds the gold and the silver makes the rules. By locking down exports, Beijing is effectively saying, the era of cheap silver for the West is over. If you want our metal, you will have to come and build your factories here. You will have to manufacture your solar panels here. We are not going to feed your industry anymore. This is a resource nationalism move of the highest order. It is exactly what happened with rare earth minerals in 2010. It is exactly what happened with Russian gas in 2022. And the market knows it. Look at what is happening in the Asian pre-market trading right now. Usually Sunday nights are quiet. The spreads are wide. The volume is low. You might see a 10-cent move. Tonight, silver gaped up by 140 at the open. We closed Friday around $66.50. We opened tonight in Asia at $67.90. And as I speak, bids are hitting $68.10. That is a violent move. That is panic buying. Who is buying? It's not the retail investor in Ohio. It's not the stacker in Germany. They are asleep. The entities buying silver aggressively on a Sunday night in Singapore are the industrial users. It is the electronics manufacturers in Korea. It is the solar panel makers in Malaysia. It is the refining clients in Japan. They are reading this leaked document, and they are realizing that their supply chain just got cut by 15%. They are realizing that come January 1st, they might not be able to get delivery. So they are running the ban. They are trying to secure every ounce of physical metal they can find before the window closes. They don't care about the price. At $68, silver is still cheap if the alternative is zero silver. If your factory shuts down because you don't have paste, you lose millions of dollars a day. Paying a few dollars more per ounce is a rounding error. This is the transition we have been waiting for. The transition from a speculative market to a scarcity market. In a speculative market, price matters. If the price gets too high, buyers walk away. In a scarcity market, price is irrelevant. Buyers buy because they must, and the leak of the January 1st lockdown is the signal that scarcity is here. But there is another layer to this story, a layer that involves the banks themselves. On Friday, we saw the CFTC bank participation report. We covered it in detail. The US banks flipped net long. They stopped shorting. They switched sides. Why did they do that? Did they know this leak was coming? Of course they did. JP Morgan has offices in Shanghai. They have deep connections with the Chinese regulators. They knew this export ban was coming down the pipe. They knew that the January 1st lockdown was real. That is why they spent October, November, and December covering their shorts. That is why they stopped smashing the price. They knew that once this news hit the public, nothing would be able to stop the explosion. They positioned themselves to be on the right side of the trade. They got long because they knew the supply shock was guaranteed. But in doing so, they left someone else holding the bag. The report showed that while U.S. banks went long, non-U.S. banks, foreign banks, increased their short position to over 200 million ounces. These foreign banks are now walking into a buzzsaw. Tomorrow morning, when the sun comes up in London, those foreign banks are going to wake up to a nightmare. They are short 200 million ounces. The price is gaping up. The supply from China is being cut off. And their biggest allies, the Americans, have abandoned them. What happens when a bank is trapped in a short squeeze of this magnitude? They panic. They have two choices. They can double down and try to short more, hoping to break the price. But how can you short a market that is driven by physical shortage? You can print paper contracts, but you can't print silver bars. And the industrial buyers don't want paper contracts. They want bars. Or they can cover. They can buy back their shorts. If they try to buy back 200 million ounces in a market where China has locked the door, where do they get the metal? They have to bid it up. They have to offer $70, then $75, then $80. They have to bid until someone is willing to sell. But who is selling? Are you selling? I doubt it. You know what's happening. Is Samsung selling? No, they just bought a mine to get more. Is China selling? No, they just banned exports. There are no sellers. This is the recipe for a super spike. a vertical move in price that defies all technical analysis. We are seeing the early tremors of it tonight, but the real earthquake starts when the Western markets fully digest this news. The media will try to spin this. Tomorrow you will see headlines on CNBC saying silver rallies on China rumors. They will call it geopolitical tensions. They will try to downplay it. They will bring on experts who say that the ban isn't absolute, that there are loopholes. Do not listen to them. Read the document. The language is clear. Strategic necessity waiver. That is bureaucratic code for no. China does not want its silver to leave. They need it for their own solar dominance. They produce 80% of the world's panels. They know that silver is the bottleneck. Why would they export the bottleneck to their competitors? It makes zero strategic sense. So the ban is real. The trap is set. And the 15% of global supply that usually flows from east to west is about to disappear. Let's do some math on that 15%. Global mine production is about 840 million ounces. 15% of that is roughly 126 million ounces. That is the size of the hole being punched in the market. 126 million ounces is more than the entire annual consumption of the United States Mint for silver eagles. It is more than the entire annual consumption of the global photography industry. It is massive, and it is disappearing overnight. The market was already in a deficit of 200 million ounces. Now you add another 126 million ounces of trapped supply that can't reach the West. The effective deficit for the Western markets is now over 300 million ounces. There is no mathematical way for the price to remain at $67 with a deficit that large. The clearing price, the price at which demand is destroyed enough to balance the market, is much, much higher. Is it $100? Is it $150? We are going to find out. But tonight, the most important takeaway is this. The rules of the game have changed. For decades, the silver market was defined by liquidity. You could always get metal. You could always lease it, borrow it, or buy it. The price might fluctuate, but the availability was never in question. Starting January the 1st, availability is the only question. The liquidity is drying up. The world is breaking into fragmented blocks. The Chinese block has silver. The Western block needs silver, and the bridge between them is burning down. If you hold physical silver in your possession, you are holding a ticket to the lifeboat. If you are holding paper silver or unallocated pool accounts or ETFs that claim to have metal in sub-custodian vaults in London, you need to be very, very worried. Because when the export ban hits and the banks scramble for physical, they are going to exercise force majeure on those paper contracts. They are going to settle you in cash. They will give you your £67 back and say, sorry, we can't deliver. Meanwhile, the real metal will be trading at $100 on the black market. This is the divergence, the split between the fake price and the real price. And it is starting tonight. To understand why the silver market is breaking tonight, you have to understand that this isn't an accident. This isn't a random policy change. What we are witnessing is the final phase of a plan that was written 10 years ago. In 2015, the Chinese Communist Party released a strategic roadmap called Made in China 2025. The goal was simple. China would no longer be the world's cheap factory. It would become the dominant superpower in high-tech manufacturing. They identified 10 key sectors: robotics, aerospace, biotech, and most importantly, new energy. For a decade, the West laughed. We thought they were just building cheap plastic toys. But while we were laughing, they were cornering the market on every single raw material needed to build the future. They did it with cobalt in the Congo. They did it with lithium in South America. And now, in the final days of 2025, they are doing it with silver. This January 1st lockdown is not about money. China has plenty of money. This is about industrial survival. Let me explain the technology that is driving this ban, because the mainstream media is completely ignoring it. For the last 5 years, the solar industry ran on a technology called PERC. It was efficient enough, and it used a moderate amount of silver paste. The West could handle the demand. But in 2024, the Chinese solar giants LONGi, JinoSolar, Trina made a massive synchronized pivot. They switched their production lines to a new technology called N-type TOPCon. Why? Because N-type cells are roughly 5% more efficient. That sounds small, but in the energy world, 5% is the difference between profit and bankruptcy. But there is a fatal flaw in N-type technology. It is a silver vampire. An N-type solar cell consumes 30% to 50% more silver than the old PERC cells. It requires silver paste on both sides of the wafer, not just the front. When China switched their factories to N-type, they effectively increased their national silver consumption by 50 million ounces a year overnight. They looked at their internal stockpiles. They looked at the mines, and they did the math. They realized that if they continued to export silver to the West to help America and Europe build their solar panels, China would run out of metal for its own factories. So the strategic necessity waiver we saw in the leak tonight isn't just bureaucracy. It is a rationing mechanism. Beijing is saying, we have enough silver for our N-type revolution. We do not have enough silver for yours. This is exactly what they did with rare earths in 2010. Do you remember that crisis? China controlled 97% of the rare earth market. In a dispute with Japan, they quietly halted exports. The price of dysprosium and neodymium went vertical. Japanese high-tech industry almost collapsed in weeks. The West screamed. We filed lawsuits at the WTO. We won the lawsuits. 5 years later. By then, it didn't matter. The damage was done. The supply chains had already moved to China. They are running the same playbook with silver. The leak confirms that starting January 1st, 2026, Chinese smelters are prohibited from exporting silver bars, unless they can prove the metal is surplus to domestic strategic requirements. Surplus? There is no surplus. They're running a deficit. This means the export number goes to zero. Now, think about the Western banks. Think about JP Morgan. Think about the London Bullion Market Association, LBMA. They have built a financial system that relies on the free flow of metal. They lease silver from China in the morning, sell it in London in the afternoon, and buy it back in New York at night. It is a carousel. On January 1st, the music stops. The carousel breaks. If JP Morgan owes ICBC 130 million ounces, and they can't ship it back because of capital controls, or if they were planning to lease more to cover their shorts, they are dead in the water. This explains why the foreign banks, the non-US banks from the CFTC report, are panicking. They are the ones who rely on this international flow. They don't have their own mines. They don't have their own vaults. They are middlemen. And in a resource war, the middleman is the first casualty. The Western failure to anticipate this move is staggering. We saw the export control law passed in 2020. We saw them add gallium and germanium to the list in 2023. We saw them add graphite in 2024. Silver was always the next logical step. It is the most conductive metal on Earth. You cannot build a missile, a satellite, a server, or a solar panel without it. The West treated silver like a legacy monetary metal, a pet rock. China treated silver like energy. We have covered the leak. We have covered the history. Now, we need to talk about the future, specifically the next 24 hours. Because when the sun rises over London tomorrow morning and the traders at the LBMA walk onto their floor, they are going to be walking into a crime scene. The leak of the Chinese export ban has effectively turned every single short contract in existence into a toxic asset. Let's play out the scenario. At 3 a.m. New York time, the London market opens. This is the physical fix. This is where the big industrial users, the Teslas, the Samsungs, the Glencores buy their actual metal. Usually this is a polite, orderly process. Tomorrow, it will be a riot because of the Sunday night gap we are seeing in Asia right now with silver trading near 68. The London market is going to open in a state of immediate stress. The foreign banks we discussed, the ones holding that 200 million ounce short position, are going to receive a margin call notification before they even finish their coffee. Their risk managers are going to look at the screen. They are going to see the Chinese export ban. They're going to see the US banks sitting on long positions. And they're going to scream one word, cover. But here is the mechanics of a squeeze that most people don't understand. To cover a short position of that size, you cannot just click buy. If you buy 5 million ounces at market price, you push the price up by $2. If you buy 10 million ounces, you push it up by $5. These banks need to buy 200 million ounces. As soon as the first bank blinks, as soon as Deutsche Bank or whoever it is places that first massive buy order, the price is going to telescope upwards. It will go from $60 to $69 in seconds. And that brings us to the most dangerous number on the chart, 70. $70 is not just a round number. It is the psychological break point. For 5 years, $30 was the ceiling. Then $50 was the ceiling. Now $70 is the final line in the sand. Above $70, there's no technical resistance. There's no historical chart data. There are no bag holders from 1980 looking to sell. Everyone who owns silver above $70 is in profit. When an asset enters all-time highs with no resistance, it enters a state called price discovery mode. In price discovery mode, the algorithms that run the modern financial world stop looking at history. They switch to momentum mode. They see a runaway asset with zero supply, and they chase it. This is exactly what happened to nickel in March 2022. Do you remember the nickel squeeze? The LME had to shut down the exchange because the price went vertical. It went from $25,000 to $100,000 in 2 days. Why? Because a massive Chinese tycoon was short and he couldn't deliver the metal. The banks panicked. The price exploded and the system broke. We are setting up for a nickel 2.0 in silver. But this time, it is not one tycoon. It is the entire Western banking system minus the Americans. And the asset is not nickel. It is the most strategic metal in the electronics industry. So here are my price targets for the week. Phase 1, the breach 70. I expect us to test this level on Monday or Tuesday. The volatility will be extreme. They will try to slam it back down, but the buying pressure from Asia is too strong. Once we close a daily candle above $70, the short squeeze officially begins. Phase 2, the vacuum 85. Between $70 and $85, there is thin air. The foreign banks will be forced to liquidate other assets to meet margin calls. We could see this move happen in a single week. This is the panic phase. Phase 3, the target 100. $100 is the mathematical target where the shortage starts to destroy demand. At $100, maybe, just maybe, Apple decides to recycle old iPhones more aggressively. At $100, maybe some marginal mines in Peru come back online. But until we hit triple digits, the supply destruction from the Chinese ban cannot be fixed. But I have to give you a warning, a very serious warning. While the price is going to the moon, the market might break. If you own physical silver in your hand, you are safe. You have the asset. You are rich. But if you own paper, if you own an unallocated account or futures contract or certain ETFs, you are walking into a trap called force majeure. Every futures contract has a clause in the fine print. It says that if the exchange determines that delivery is impossible due to circumstances beyond control, they can settle the contract in cash. Imagine this scenario. Silver hits $100. You're cheering. You think you made a fortune. But the COMEX declares force majeure because they can't get metal from China. They close your contract and they send you a check for the settlement price. But what is the settlement price? Is it $100? Or do they halt trading at $75 and settle you there? And even if they give you $100 cash, try taking that $100 and buying an ounce of physical silver. The premiums on physical coins will be 50%, maybe 100%. The dealers will be sold out. The websites will be crashed. So you will have a pile of fiat currency that is rapidly losing value, and you will have zero silver. This is why the January 1st lockdown is so critical. It separates the real market from the fake market. The Chinese know this. That is why they are banning exports. They don't want paper profits. They want the metal. The US banks know this. That is why they went net long. They want to be on the receiving end of the physical delivery. The only people who don't know this are the retail investors who are still playing in the casino. So here's my final verdict. For Sunday, December 21st, 2025, the leak is real. The export ban is coming. The supply chain is broken. The foreign banks are trapped. We are about to witness the greatest wealth transfer in the history of commodities. It is flowing from those who hold paper promises to those who hold physical reality. If you have been waiting to buy, you are out of time. The window closes tomorrow morning. If you are thinking of selling, you are insane. You are selling a winning lottery ticket before the drawing. This is not a drill. This is the end of the suppression. This is the beginning of price discovery. Watch the open, watch $70 and hold on tight. The January 1st lockdown has begun. We at Currency Archive want to thank you for being part of this movement. Subscribe.